and ask questions. This is Maddie Brown, and we are having a year-end planning session here. And we're going to cover 2018, the Tax Reform Act of things that are impacting 2018 taxes. We're going to talk about understanding your financial information, and we're going to talk about planning for 2019. So I've got a long list of things that I want to cover, and I want you to ask questions if anything comes up. You know, just chime in and ask a question, because I would rather get the questions answered. If you have the question, then the odds are that very other people will have the same question. So I want to start off with what I think is really the most important thing about your finances, and that is you need good current records, okay? And in order to make any decisions at this point for 2018, you've still got days to pull everything together and make decisions and do things differently before the end of the year. And if you don't have the records in place, then you are not prepared to make those decisions that need to be made at the end of the year. So it is of critical importance that you pull together records. Now, there's all different ways that you can pull together records. You can put together records on an Excel spreadsheet. You can put records in QuickBooks or Xero, or there's Bench. There's all different ways that you can accumulate those records. But the biggest way, people want to know how they can save in taxes, and the biggest and the best thing that you can do to save on taxes is have good records. Because if you're doing your records next October, you're not going to remember things. You're going to forget things. Things are going to get lost in the hustle and bustle. And the reality is that every $1,000 of deductions that you come up with represents somewhere in the neighborhood of $40 worth of tax. So I always like to talk about car mileage as an example. Mileage rate for 2018 is 54.5 cents a mile. That means that $54.50 for every 100 miles that you drive is a deduction. And you take 30% of that, so you're looking at $16 being a tax savings to you. So you need to keep track of every mile and every record so that you can be prepared in order to do the tax returns that you need to do. And that is the #1 way that you can save on your taxes, by making sure that you have everything. The other thing that does for you is it makes you essentially audit proof, okay? Because if you have the records, when the IRS contacts you, they will say, we want to see your detailed records on your car. We want to see the detailed records on your office supplies. And if you have that information, then you're prepared to work with the IRS and you don't lose deductions without having the records that you need to have. So the first step is to have good records. The reason that you need good records is so that you can make good business decisions. That's what your business records should do for you. Now, when clients work with us, we send out every year, every month, a financial statement. And it looks a little like this. And the one page of it is called a profit and loss. And that lists all of the income and expenses that you have had for the year. Now we can see in this particular business, they had $359,000 worth of total revenue. And we can see that they paid outside consultants $50,000. They paid wages $51,000. And each category of expense is listed, and the total deductions for the year come down to $115,000, which gives you ordinary income of $135,000. Now that $135,000 is what you're going to pay tax on, okay? It doesn't, as long as, it doesn't matter if you've taken the money out of the business or you've left the money in the business, or if you have committed to do something in the future, those things don't factor into it. You take the actual revenue that you've brought in and you subtract the business expenses, and you can see that there's $135,000 worth of profit. In the real world, in the United States, I know we have one person that this won't apply to, but you can approximate on this $135,000 federal and state income taxes of roughly 40%. And I have a lot of people that say, you know, I'm working to pay my taxes, and there's some truth to that. But you still have the other 60%. Okay, so $135,000 worth of income is a good decision. So then you need to look back and you can say, well, I had a lot of car and truck expense. I had where the money went. This form tells you where the money went in your business, what you spent the money on. And each one of these will have a detailed transaction that lists every transaction in each category. So if I am looking at this profit and loss, and I want to know who the outside consultants were, I can look at, and all of the outside consultants were Natalie, okay? And so if you have the records that you can look at, you can see where your money is going, and you can make a decision about whether or not that's where you want your money to go. Now, I recommend making decisions from the standpoint of what I'm going to gain from it, okay? So the first step in the decision-making process is it something that I want to do, be, or have? And you have to get really honest with yourself if it is something that you want to do, be, or have. And sometimes the answer is no. And you need to be really clear on that. And then the second step of the answer is, will it take me to my goal? If my goal is to have $500,000 worth of revenue, if my goal is to have $1 million worth of revenue, will what I am talking about move the needle towards your goal or away from your goal? And if you are confident and you see more opportunity, then my recommendation is that you incur the expense and you go forward and you commit both mentally and financially to the decision. And it will always result in the best answer for you, okay? So as I'm looking down through this, I would want to know why we spent $16,000 on insurance. And I would look at the detail and see that we had liability insurance, we had health insurance, we had professional liability insurance, we had workers' compensation. And so you can see that the biggest piece of that is the professional liability insurance. So if that's a value to you, then it's worth doing. If it's not a value to you, then you need to look for a cheaper option. In general, there are ways to cut expenses, and you can make decisions about what you want to invest in by using this profit and loss to make those decisions. And you're always going to come up against your revenue and the expenses that you want to incur. There's some worksheets that were sent out, and I'm going to go through those in more detail, but the first thing that I want you to do is get your records for 2018 current and up to date, okay? So that you can actually see what happened in 2018, which is going to enable you to make decisions about 2019. Does anybody have any questions on that? When we send out the profit and loss detail, if there's anything that is not classified where it belongs, it comes out on an Excel sheet or a Google Doc. And if there's anything that is misclassified, then we need to know and make that adjustment. So it will say who it was paid to and the amount that it was paid, and you can see each category of expense.
Maddie, I have a question. If I have a lease, am I still doing the mileage? I thought you didn't do that when you had a lease.
That's correct.
Okay. And the other question is, could you name one more time you had Excel, the different ways that you can have your, document or, input your records?
Okay. So I want to address two things on what you said, Tana. One is you still need to keep the mileage records on that leased car, okay? Because they're going to ask you to take a business percentage of the lease as a deduction. And if you try to say that a car is 100% used for business, you're going to find that the IRS doesn't believe that, because they think you stopped at the grocery store at least once or twice throughout the year. So if you say that you always used a car for business, you don't have any ground to stand on. You don't have what I call a defendable position. Now, if you say the car was used 90% for business, you can quibble about the other 10%, okay? But it is never 100% deduction. And that it's just not, because we all do different things with our vehicles. And the leased car is deductible as a percentage. So this $6,756, if it's 50% business, then 50% of the lease is going to qualify for a deduction, okay? Now, but you still need the mileage records. There's little boxes on the form that's on the IRS form that says, do you have evidence to support your mileage deduction? And the second thing that it says is that evidence written? Now, it doesn't have to be anything fancy, but you need your beginning mileage and your ending mileage, and a calendar will work, okay? But you need to be cognizant throughout the year and make sure that you do that. And then cell phones these days, there's hundreds of apps that will track your mileage for you and do that much better than paper and pencil will do, because it's done currently, okay? Now, as far as keeping records, you can set up an Excel spreadsheet and you can record transactions in an Excel spreadsheet, and I think that is a fine way to start off. I encourage you, if you're growing a business and you want to be in business for the long haul, the sooner you start keeping records and reviewing your progress on a monthly basis, minimum, the sooner you're going to get profitable and you're going to have the historical data to compare what happened in the first year of business versus the second year of business. One of the criteria that the IRS uses is, are you in the business with the intent to make a profit? If you are not in the business with an intent to make a profit, then expenses are not deductible, okay? And so one of the ways that you can demonstrate your intent to make a profit is having good financial records. There's a company called Xero that starts with an X, E-R-O. Some people use FreshBooks. There are people that use Mint. Mint does not provide you with the records that you need in order to really make good business decisions. And so I encourage people, you can get on QuickBooks Self-Employed, and then you have the data and you have everything that you could use to make decisions going forward. And so I always recommend that you get started with some kind of bookkeeping system. An Excel worksheet works, but it doesn't give you comparative data as you go forward. Okay, does that make sense, Tana?
Yeah, Maddie, that makes sense.
Okay.
Is FreshBooks the same as QuickBooks?
No.
Okay.
FreshBooks, a lot of people use FreshBooks for invoicing, and it is a very good tool for invoicing, and then they kind of, as an afterthought, do expenses. And it really isn't the best main bookkeeping system that you could put yourself into. And the sooner you set yourself up and behave and work like you want to be, what would a chief executive officer do? What would a bigger business do? And you want to model that behavior. And that means keeping good records, okay? So the purpose of the records is to say that this $135,000 was a good profit on $400,000 worth of income. So you're looking at roughly 30% profit, which in a service business is attainable, okay? In a lot of other businesses, that is not attainable. And most businesses operate on a much lower margin than that, okay? So people talk about $359,000, $400,000, $1 million worth of income, and the reality is, I can make anybody $1 million business. You can make me $1 million business, and I can make you $1 million business, and all we have to do is exchange checks. And you've got $1 million worth of income and $1 million worth of expense, and you're $1 million business, but you don't have $1 million in your pocket. And so you've got to be aware of your spending and make it intentional and something that is going to carry you forward into the profit that you want to have. Okay, any questions? So the next thing that I like to do is I like to look at a monthly spread of the income and expenses. And what this does for you is you can look back and you can see what happened in previous months, and you can see that something wonderful happened in July. Okay, there's $50,000 worth of income, and October was good. So what are the factors that have made that happen? And when you look at a monthly spread of your income, you can come down and you can say, well, my insurance was the same every month, $1,442. My professional fees were the same every month, $123. We had some repairs, and you can look at these numbers, and these numbers tell me a story about you and your business and what's important to you and what do you want this story to look like at the end of the day. And if people get caught up in watching their bank account go up and down, and they lose track of the vision that they have for their business. And what I want, once we've got a sound base and we know what the history has told us, then we can make intelligent decisions going forward about how to make things better and improve things. Okay? So the next step, once you have these records, is to look at where you want to be. And you're going to have a worksheet where I'm in the wrong place. Sorry. I'm going to share my screen again. Shuffling windows. I use a worksheet that talks about setting goals and talks about how you want this picture to look as you're going forward. And you need to take the first step of doing that is to know the history of where you are. And the next step in doing that is to look at where you want to go and what you want to do and where you want to be in the world. Now, most accountants are going to talk to you about your income and expenses, and they're going to say, you know, you need more income and you need less expenses, which is always true. That's always good advice. You know, you need more income and you need less expenses. That's a no-brainer. If you want to move into the new year in as good a tax situation as possible, then what you want to do is you want to accelerate any expenses into the current year, and you want to defer income into the following year. And so that's a general assessment. It is not always the case. So I talked to a woman yesterday that is going to have a big $40,000 chunk of income come in right at the end of December. And she has the opportunity to spend some of that money and lower her tax bracket. If she could defer it, it would lower her tax bracket. So she's looking at balancing the income and expenses so that you get a result that is relevant to where you want to be for tax purposes. Okay? Now, if that falls over into the next year, we don't have as much information about what the taxes are going to be for 2019. So it's generally good advice to defer income and to accelerate expenses, unless you know that you already have a big loss. If you know that you already have a big loss, then you want to bring income in because you can offset it with the loss. And it keeps your income more level in terms of what you're reporting. So there are circumstances where you want to accelerate income, but it's not the general rule, okay? So when you look at your business the first thing that I want people to look at is what do they want to have in their life. And I use 7 categories when I look at what I want to have in my life. And this is something that I go through and do every year. Sometimes I go through twice a year, but I reevaluate. And this is a moving target. It is not a static decision. Your career and professional goals may change in an instant, okay? My intentions changed on November 18th for what I was going to do the next day because I fell and broke my shoulder, okay? So things change in an instant, and you know things are going to vary, but you want to look at what you want to have in all aspects of your life. And I like to put together 3 things, and they need to be achievable. They need to be SMART goals. They're specific, they're measurable, they're measured in time, and they're realistic. Okay, so career and professional. I've got an employee that is working on her CPA exam, and so that might be something that she would have on that personal, professional, and career and professional. Personal relationships, personal life. Those are the things that you want. If you want a Mercedes, if you want a house on the ocean. Financial goals. What do you want to have in the bank? What do you want your financial picture to look like? Your health and lifestyle. Do you want to have a gym membership? Do you want to, lots of people want to lose weight, and they just say they want to lose weight. And the reality is, what you need to say is, I want to lose 20 pounds by June 30th of 2019. Once you have set that kind of goal, then you look at the steps that it takes to meet that goal. So as you allocate time and effort to all of these goals, you don't want everything in this career and professional and financial arena. You want a balanced perspective. You need other things. And people are all the time telling me that I need a hobby. Well, and I tend to tell them that my hobby is work, which is probably not the best scenario. But I am making plans that I visit my mother on a regular basis. And so that is something that I factor in. Now, when you make that goal, the column C talks about when the goal is going to be achieved. And here's the piece that most people don't ever get. The piece is, how much is that goal going to cost? If I want to visit my mother every 6 to 8 weeks, how much is that going to cost me in order to do? Well, I'm going to have a plane ticket, and I'm going to have a taxi ride, and I'm not going to incur a lot of expenses. I've got a place to stay. And so it costs me on Allegiant Airlines $150 to $200 to go to Florida. Okay. But I factor those things in to what I want to have out of my business. Okay, because your business needs to support you in all respects. And if you don't have a balanced perspective, then it's not going to be sustainable. You will lose the ability to move forward. The last thing that I like to look at is, what is your legacy? What do you want to be remembered for? And what's your gift? So once you have taken a little bit of time and studied this, another thing that I really like to do, and again, it's something that I do on at least a yearly basis. But I sit down and I write out what my ideal day looks like, who I want to be working with, who I want to be talking to, who I want to be helping, what I want to be doing. And I keep that in the forefront of my mind so that when I'm making decisions about business expenses and I'm making decisions about things that I'm going to do, I'm looking at, does that decision take me closer to my goal, or does it take me further from my goal? If it takes you closer to your goal, then that's great. That if it doesn't take you closer to your goal, then you've got to look at what does it mean to your business if you do that and it doesn't take you closer to your goal. Because the most important thing that you can find out by going through this process is how profitable you need to be. And that's where I will differ from a lot of accountants, because I start at the bottom line, which is personal expenses, groceries, mortgage, real estate taxes, healthcare expenses, walking around money, all the things that you spend money on to live, okay? And when you have a total of what you spend money on to live, I make a separate sheet for auto, and I make a separate sheet for debt. And those three categories combined pull together what you need to have to live. And that might be $2,000, it might be $5,000, it might be $10,000. There's nothing right or wrong or true, but the first step is to really know what it costs you to live and what kind of money, what is going on? What kind of money you need to make in order to sustain life as you know it, okay? So that's really the step one, the goals and the professional. What do you want things to look like? So if one of the things that you want in your personal life is a housekeeper, how much is the housekeeper going to cost? And then when you come over and look at your personal expenses, you want to make sure that you have a housekeeper included in those personal expenses. So these are not necessarily historical numbers. These are numbers of where you want to be and what you want your life to look like. So I have a client that finds it, she wants to have a chef that cooks meals for them. So if she wants to have a chef that cooks meals for them, then you need to factor that in to what you need to have at the end of the day. Any questions? Okay. So once we have that number, then the next number we're going to talk about is business expenses. And your business expenses are anything that is ordinary and necessary in the scope of your business. A lot of people ask questions about what can I deduct? And you can deduct anything that contributes to the profitability of your business. If you can prove that it was ordinary, it was necessary, and that the primary purpose of it was business. That's the criteria. If it sounds funny to you, the odds are an IRS agent is going to think it's hysterical, okay? So that gets back to the importance of really having good records so that you can show why the trip to Maui was a business trip. What was the purpose of it? What did you do while you were there? Document it when you take the trip. Put it in your expenses, deduct it, and then 3 years later when the IRS asks for it, you've got all the documentation that you need. Now, I always tell a story, most anybody that's heard me talk, my mother and her husband Earl had a coin-operated laundromat for a lot of years. And Earl bought a riding lawnmower, big hunk form, and he wanted to know if he could deduct it on the books of the laundry. What do you think? Well, I do have to humor him because he is my mother's husband, but I don't have to get in the car with him on taking this deduction. And the question is there any grass at the laundromat? Can we say that the primary purpose of that lawnmower is to mow the grass at the laundromat? Now, if you have an acre of grass and you use it for business, then you should claim it. What businesses have as deductible varies based upon the nature of the business. So if you are in a sports bar, they're going to have TVs and they're going to have the services to play all the sports games. That may not be true in a insurance agency, okay? They don't need a TV. But if you can show the business use and the business purpose, then you can claim it as a deduction, okay? So what you need to include under these business expenses, I always start out with an average of what my last year's expenses were, unless I have made changes. So I go back to that worksheet that we had that had the monthly spread on it. And I take these categories as my average monthly expenses on my business. So in this particular case, the average monthly expenses are, let's just say $10,000 because the math is easy, $115,000. So we know that we're going to have these expenses. They're not a surprise to us, and we expect to show those expenses as our income and expenses. So that's where these numbers come from, and then you edit and adjust, okay? So now we've got our personal expenses, we've got our goals for the year, and know what our business expenses are. And this is going to seem really crazy, but now we know how much money we need to make. And you've got your business expenses, you've got your personal income taxes and self-employment tax, you've got your personal expenses, your debt, your transportation, and I always recommend a 10% savings account. There's a book called Profit First, which is kind of a model of the old school way of when you got your paycheck, you divided it up and you put it in envelopes, and you spend X number of dollars on groceries and X number of dollars on rent, and you don't spend any more than you have in the envelope. And that is the premise of what Profit First works on. One of the things they do is they recommend a set profit account where you set money aside each and every dollar that comes in, okay? And that is a good strategy. The other dollar that you need to set aside is your taxes, okay? And generally, just to make things simple, I like to look at your profit, and I will say 1/3 to 40% of that is going to be payable in taxes. So the bottom line is the gross receipts have to be a large enough number to cover all of those categories. Now, if you find that that number is $20,000 a month and you are making $10,000 a month, then you're going to have to shift, and you want to shift in the direction of making yourself more profitable. Do I have any questions?
Oh, am I?
Maddie, it's Margaret.
Yeah, Margaret.
I do have a question. I bought a large piece of equipment, and it's not a lawnmower, and it is pertaining to my business, but I don't think the whole thing can be written off at once. How does that work?
Okay. Depreciation is how you write off expenses or big budget items, things that you're going to use, like a computer. You're required to do what they call depreciation on that computer. And so if you buy a $1,000 laptop, you're going to deduct on your income taxes depreciation for that laptop. And the IRS has everything broken down into useful lives of 5, 7, 10, 15, 20, 30 years. And everything that you can look at has a specific useful life. And you basically spread the deduction over a period of 3 to 5 years, 7 years, 15 years. A real estate, a commercial building, you've got 30 plus years that you deduct that over. Now, there is a special kind of depreciation. It's still depreciation, and it's something that is called Section 179 depreciation. And that 179 depreciation allows you to take a full deduction this year in your taxes, okay? So if you buy a $1,000 computer, you're going to depreciate it, but you do have the availability of taking Section 179. It is an option. It is not mandatory, and you can make that decision when you file your income tax return. Now that's limited to $500,000, which is not a problem for me, and I think it's not a problem for most of the people that I work with, although we have some farmers that buy some pretty big equipment, okay? And so the Tax Reform Act increased the amount of assets that can be taken as a Section 179 depreciation, and the reason for that is to incentivize spending and growth and expansion in the small business community. So that's what their intention is. So yes, you can deduct it. You can deduct it over a period of time, or you can deduct it all in 1 year, depending on what you need to do from a tax standpoint. Does that cover what I think your question was, Margaret?
Yeah, that was a great answer. Mike, I have one other question in regard to that. I don't see a downside to deducting it all at once.
Well, here's the downside. You may need the deduction in a future year. If you've got a loss, or if you've got $400 worth of income, there's no there's no reason to generate a bigger loss with the 179, okay? And so the downside depends on how much income you have and what tax bracket you're in and what tax bracket you expect to be in in the future years. Now, if it's 7-year property and you're going to depreciate it over 7 years, you can't take all of it in the second year or the third year. You can either take it all in the first year or you have to spread it out over time. And it just depends on the fact situation. You know, the greatest answer for anything is it depends. It depends on what your intentions are. It depends upon what you expect your business to be doing next year versus what you expect your business to be doing this year. And so it's not a black and white decision. The other factor is there is a requirement that if you dispose of the property before the useful life is expended, you have to recapture the Section 179 depreciation. So if you had that $1,000 computer and you sold it a year later, you would have gain to report back on that Section 179. Does that make sense? It doesn't really make sense, but it is.
You answered all my you answered all my questions and read my mind and answered the questions that were still in my mind. So great, thank you.
Okay. So when I talk with business owners, I want you to look at your whole life. I want to make sure that you are covering what you want to cover, that your business is financially sustaining you. And that needs to be, it needs to be fun. It needs to be something that you are having a good time doing. I've been in places where I was not so happy, and life is way too short to be unhappy. And you have the ability to change whatever you're doing so that you can be happy. And I never advocate that you are an unhappy situation. Something needs to change, something needs to be different. So when you're looking at your numbers, you're looking at setting aside ideally 10% profit. Then you're looking at 33% to 40% in taxes. You're looking at 40% in business expenses on average. And the remainder percentage goes to your personal account. So I recommend that you sit down on a monthly basis, look at what your revenue was, allocate your expenses and your personal and your profit savings, and work towards making sure that your business expenses don't eat up everything that you have. Now, does that make sense? Does anybody have any questions? I like it when you ask questions.
Hi, Maddie. This is Stephanie. I have a question.
Okay.
You talked about your shoulder injury, and I actually got an injury last year, and I'm still starting my business. So the year before, the last good year, I had 12 grand in income, and then this year I think it might be like 5 grand because I haven't been able to work as much as I wanted to.
Mm-hmm.
Talk about that a little bit.
Well, as a sole proprietorship, you pay taxes on the income that you receive, whatever that net number is. The IRS looks at it's not going to cause you to be looked at any harder, okay? Unless you're talking multiple hundreds of thousands of dollars, okay? But a difference from under $50,000 is probably never going to trigger the computer at the IRS to look at your situation. And they look at cash-based businesses, and they look at things where there are really high expenses in a given category. So if you file a return with $100,000 worth of coaching paid on that return, your odds escalate because of that large expenditure, which makes it even more important to have the records and to document the business purpose of things. But you're not, and then the second part of that scenario is if one thing that you want to aspire to being able to do is having two things. Number one, a buffer of savings from this 10%, okay? So that if you have 3 to 6 months of your monthly expenses set aside so that you are prepared to cover your life. And the next thing is that you look at disability insurance. And I've got a client that routinely makes $50,000 a month. If she stopped making $50,000 a month, her life would really deteriorate on a rapid basis. And so she needs to have a short-term disability policy to protect herself. So there's two ways to protect yourself. One is to have a savings and a buffer that you never go below. And the second is to have disability insurance, which covers any potential risk, okay? And most entrepreneurs and small business owners operate on very thin margins. And this 10% savings becomes really important. And it takes a strong constitution to regularly set aside the tax money and the gross savings. But that is really where your security comes from. Did I answer your question, Stephanie?
Yeah, a little bit. That's good to know that disability insurance is an option. And can you talk about kind of regrouping? Like I wanted to be, it's kind of had the idea of making 24 grand, doubling the 12 to make 24 and then go up from there. Can you talk about regrouping your business maybe and just kind of
yeah. Okay. So once you go through step one and you have your goals, your personal expenses, your business expenses, and you know that you need to generate $2,000 a month. We'll use Stephanie's number, okay? We know that we want to generate $2,000 a month. In order to create $2,000 a month in revenue, you're going to have taxes, you're going to have expenses, you're going to have business expenses, taxes, and you are going to have your savings requirement. So the real number that you're going to be looking at is probably $4,000 to $5,000. Okay, and we'll go with $4,000 at this point. So the next question is that $4,000 then drives what you need to sell and how you need to sell it in your business. So if you work with clients on a one-on-one basis and you charge $1,000 a month, you need $4,000 a month clients. And how those numbers work depend on the nature of your business and what you provide. What is the product or service that you sell? And what is the price point that you sell it at? And how many of those do you need to sell in order to generate the $4,000 to $5,000 a month that you want to? Once you have looked at what you want to generate and what you need to generate, then you look at the products that you sell and the services that you offer and break them down into those categories. And that dictates what you do today, because you focus on, if it's one-on-one clients at $1,000 a month, there's an adage that a mentor of mine says that you can't chase two bunnies. Okay, if you're in pursuit, you have to focus on what it is you're selling and who it is you're selling to, and do what generates cash today. Okay, and there's all kinds of marketing techniques and things that you can do from a marketing standpoint, which is not my strength. But once you know the number that you need to generate, then you can start making up scenarios that would generate that number on a monthly basis. So if it's 24,000, talk to me, Stephanie, about what you sell, if you don't mind.
Sure. I'm a yoga teacher and I do energy healing work.
Okay.
So I work out of my home, do it, on my massage table, and then I have a large room, well, kind of my extra living room, where I do yoga privates. And I'm kind of having these tiers of trying to figure out. I mean, I've done so many scenarios, so like I know all my scenarios work. It's just a matter of them coming together. So I love teaching yoga, but I'm finally able to have enough energy so I can teach 4 to 5 classes a week, but I only get $35 a pop. So that's not, I need 50 grand a year to live at a minimum. So it's not
sustainable.
No, but it's a place where I've been getting my confidence, and I think it's been great. But I think what you're talking about, I need to kind of shift my focus. But then I get confused because people are like, "Oh, you need to follow your heart and what you love, and then the money will come."
Well,
But it's like, well, there's still no money at $35. There's private yoga at businesses, but even that, it's still 75 or 100, and it's not the private clients that are paying me 195 for a 90-minute session.
So here's what I take away from what you're saying. Okay. When you are focusing, number one, you need to do something that you love to do. That is absolutely truth, because if you don't love to do it, it's not sustainable. It's not something that you can continue doing, and that applies to everybody. Okay. So number one, you have to love doing it. Okay. And thinking that you can sit back and wait for the money to come to you is a fallacy, though. Okay. So you've got to take action and move towards that revenue that you want to provide. So if you know that your one-on-one yoga client is $200, let's just use easy math, okay? And we want $4,000 a month. How many yoga sessions do you need to do at $200 a yoga session to generate $4,000 worth of revenue? Is that doable? And if you focus on marketing the one-on-one private yoga sessions, you will still do the yoga classes and the corporate and the other things that are relevant, but you don't focus your energy on marketing that. So if you narrow in your marketing on something that you know that you know that 20 monthly sessions will cover, then you know that your target is 20 monthly sessions and with private yoga. And then anything else is gravy, so to speak.
Right.
Does that make sense?
It does. I think because I've only have limited energy, I've been putting so much energy into the classes and it's nice because now I'm starting to branch out to put my energy towards, yeah, and I just have to keep doing that, put my energy towards getting more sessions and more. And I'm trying to even do a program where people will work with me for 6 months, to get better from illness or chronic pain. And those clients will pay, two, three, $5,000 for 6 months. So that's another place to focus on to get the income flowing. And I love doing everything. So I may as well just focus on the things that give me money.
Right.
Okay.
You need to focus on something you love to do, and secondarily, you need to focus on the things that are going to generate the most revenue currently, okay? And cash today, cash tomorrow, cash in the future. So what you focus on is cash today,
Okay.
okay?
Great.
And that's true of anybody. If you're talking about generating $1 million, you've got to focus who you market to and what you expect your revenue to come from, and you need to go through the calculation that creates the revenue that you want it to create every year when you do your planning. Because that tells you and it dictates. If you know you want 20 one-on-one sessions, you're going to do different things than you would do if you are marketing classes. So your focus and what you do varies according to what your intentions and your plans are.
Yeah, that's great.
Okay.
Thank you.
You bet. Do we have any other questions? I really like it when you ask questions. Let's think of questions. While we're thinking of questions, I'm going to introduce Christine, who is an employee of mine. She's an enrolled agent, and she's not showing her video today. And we have Becca, who is an important part of our operation. And you may or may not, there's Christine. She decided to show her video now that I've harassed her. And we have Becca, and we have Angie, who says Maddie. And these are all people on my team that we work with and help make things happen in my business. They do a great job, even when I'm absent and on drugs. Okay. Any questions, thoughts, anything you want to talk about? I want to talk about the changes from the Tax Reform Act now and how that impacts small businesses. And it's apt to get a little confusing. And so I forewarn you that it is a little confusing, and they didn't simplify anything, okay? Nothing is simpler than it was before. Now, not saying that before was easy, but the more levels of issues they create, the more complicated my job becomes. There still is a requirement to have health insurance, and we still have to monitor the health insurance, and we have to get copies of the W-2s and the 1099s and all of the appropriate documentation. So when we ask you for that, we're accumulating things that we are required to do. And we want to make sure that we have everything in one place. We keep everything digital, and we want to make sure that we have the information so that if you come to us in 2 or 3 years from an IRS audit, that you actually have the records that you need in order to support the deductions that you've got on that audit. They changed we've always been able to have what we call a personal exemption. And we've also been able to have something called an itemized deduction. Well, they eliminated the personal exemption and they increased the itemized deduction, the standard deduction. It's the standard deduction for a single person is $12,000 and the standard deduction for a married couple is $24,000. So if your income is under that level, you may not have any tax liability. And I say may not because if you are a sole proprietorship, you still will have to pay what they call self-employment tax on those earnings. There's two kinds of tax free. One is income tax, and the base rate for 2018 is 12%. And it goes up to a maximum of 32%. And what rate you pay depends on the level of income that you're at. So the personal exemption of $24,000 for a married couple is going to cover a lot of income, but it doesn't necessarily cover self-employment tax. And self-employment tax is 15.3% of every earned dollar. So if you have $1,000 of net profit, you're going to pay $150 of self-employment tax. You will not owe any income tax, but you will owe self-employment tax. That's the big secret. Most entrepreneurs go into business for themselves and they kind of understand that they are going to owe income tax. And they think of the income tax, and that, again, for 2018 is 12%. If you tag on the 15.3% for self-employment tax, and you tag on something for the state that you live in, there are a few states that do not have state income tax, but if you total all that, that's where I get the 33 to 40% that I'm talking about to set aside as taxes, because you've got self-employment tax and you have income tax. They both impact your tax return, and they're filed on your individual 1040. They also doubled the child tax credit. Instead of $1,000, that's now $2,000. So they took away the personal exemption for the children, but they increased the child tax credit. So most people are going to pay less tax in 2018 than they paid in 2017. You can't claim that uniformly across the board, but for the most part, people are going to pay less tax in 2018. The problem is when they adjusted the tables for withholding, they gave you that tax decrease into your withholding. And so if you have a W-2 from a job, it is possible and likely that they didn't withhold enough money from your paycheck. And so we've got married couples that have two incomes, that have healthy incomes, and the withholding tables went down, so they got more in their check every week or month or how often they were paid. But when they calculate the taxes, that calculation results in a higher tax than what they have paid in. And so one of the things you need to be sure you do is review your withholding if you have withholding from a job. If you're self-employed, you are required to make estimated tax payments, and you're required to pay those in on a quarterly basis. If you don't pay them in on a quarterly basis and you leave and pay them all at the end of the year, you will pay a penalty. Now, it's not a great, huge penalty, and it generally approximates interest on the money. And so it's not a crisis if you haven't made estimated tax payments, but it is a requirement that you make estimated tax payments. So my job is to tell you that you need to do it. Your job is to do it unless otherwise decided, and that's where I need to land on it because it needs to be done every quarter. So one of the biggest things that is happening this year, there's something called a pass-through deduction. And that pass-through deduction is 20%. And it is 20% of your net profit. So if we think back to that $135,000, you would take 20% of that $135,000 and you would deduct it from your taxable income. It doesn't reduce your self-employment tax, but it reduces your income tax. And there are limitations, and those limitations begin when you reach $157,000 on a single return or $315,000 on a married filing joint return. And so the calculation is limited if you are over those limits. If you aren't over those limits, then your earned income from your business is going to qualify for a 20% deduction. And that would be $20,000 on a $100,000 profit, okay? So the whole thing gets kind of confusing, and there is on our website, which is smashingnumbers.com, there are calculators on that website. If you go to smashingnumbers.com and you go to the tab that says resources, and then go down to where it says financial calculators, you can plug in your income and your expenses, and if you qualify for the 20% deduction. W-2 earnings do not qualify for that deduction. So it is business income from an S corporation, from a partnership, from a sole proprietorship, all in 1120S. All of those entities pass through a 20% deduction to their owners. So there's calculators that are available to help and make things simpler, but it's not a black and white situation. They're still discussing whether it applies to rental property or not and how it affects real estate professionals. And we are still waiting on guidance from the IRS on any number of things. They changed. Meals and entertainment were impacted by the Job Tax Act, and entertainment is no longer a business deduction. Meals still qualify for the 50% deduction, and there are occasions where meals qualify for 100%. And they've made it virtually impossible to track correctly everything to do with meals. There's a flow chart that is very frustrating. And so we're still looking for guidance, and we're looking for information from the IRS on how we need to apply these rules. From a business standpoint, this 20% flow-through deduction is the biggest criteria that is impacting this. The problem is not in the income tax rates. The problem is in how you define taxable income. So all of those deductions that we're taking and the rules and the regulations that go around those deductions is where the complexity in our income tax comes from. the rate is easy. 12% to $73,000. The rates are easy. The problem is defining taxable income.
Maddie, it looks like you have a question.
Okay.
Marguerite.
Yes. Hi, everybody. Thanks so much. Maddie, this is great. And I think that's where my question was coming in, because usually every year, I make what looks like a lot of money, but when all of the deductions are taken, I'm, at a much, much smaller taxable income, quote unquote. So
Right.
Is it that is gauging what this 20% is
Yes.
eligible for? Okay. So in other words,
It's 20% of the net.
of the net, of the gross adjusted or taxable income, whatever it is. Okay.
Correct.
Okay. So that's a big difference this year from last year, is what you're saying?
Yes. Yeah, that 20% did not exist in 2017.
So that would be a significant
Right.
discount.
If you have $100,000 of net income, you're going to get a deduction of $20,000,
Wow.
and at 12%, that's $2,400 tax. Does everybody follow what I just said? If we have a $100,000 deduction, and that's the only $100,000 worth of income, and you get the 20% deduction, it's going to save you $2,400 in tax. Okay. It's not, the 20% is not a reduction in tax. The 20% is a deduction in arriving at what you pay tax on.
Okay. Okay. So it just keeps lowering how much money you have to pay taxes on.
Correct.
Okay. I don't know that I've gotten the whole thing of all these nuances and everything. And I mean, so like all in all, is this good news for entrepreneurs who make,
All in all, yes, it is good news, and it is going to save tax dollars. Some people are going to benefit more than others. If you have, the higher your income is, the less benefit you're going to see from it. If you are a single person and your net income is over $157,000, then the deduction is phased out.
Okay.
And so to say any black and white thing doesn't particularly work. Okay, you've got to look at the overall picture and other aspects of income. When we did the 17 returns, we automatically checked the 2018 projection, and consistently, most people were paying less in taxes. Okay, but there were exceptions to every rule.
Yeah.
Okay.
Okay, but in a way, that's good news, because I thought this whole thing was going to be worse on entrepreneurs. And I know you had personally said to me it would be better, but I guess this is why.
Yes.
Okay. All right. Thank you very much.
Okay. Do we have any other questions? I'm happy to answer questions. If you want to have a further conversation with me, if you'll go to my website at smashingnumbers.com, there is a place to make an appointment, and you can choose a time that is convenient to you, and I'm happy to have a conversation with you about anything that we've talked about here and things that you may need. I'm going to recap by saying that the first step is to get good records. The second step is to make decisions that generate profitability, okay? And the third step is to deal with the IRS to the best of our ability. Any other questions?
Maddie, it's Tana.
Yeah.
Hi. I have a question. I am going to be starting up a new business. So do you have any suggestions for, any suggestions for how to kind of get yourself on track in having a new business?
Couple of things that, as far as a new business, number one is you want to create a plan that generates the kind of revenue that you want to generate from the business. And then you need to look at the feasibility of generating that much revenue. Okay, so if you know you want the business to generate $10,000 a month, okay, then you've got to look at what you have to do in order to generate the $10,000 a month. And maybe it's 10 one-on-one clients at $1,000 a piece, okay? And that truly is the first step to going into business, okay? Because if you don't have a model, a business model, and a plan that is generating the revenue that you want to be generating, then you shouldn't be doing the business, okay? And so that really is the first step. The second step, there's a 25 tips on my website, and it covers all the basic things that I tell everyone that they need to cover when they're starting a new business. The best scenario is you're going to open a separate checking account. You're going to keep the income and expenses separate and not commingle them with your other business or your other personal expenditures. And those two things are really the fundamental thing that you need to do up front. You need to make sure that you set up a separate bank account and keep your transactions so that you can identify what transactions need to be recorded in that new business. And the best thing you can do for yourself is creating that financial plan, because that tells you the viability of the business that you're talking about, and it tells you what you have to do in order to accomplish that, and then you can decide if that is something that you want to do or not.
Okay, what is that named, your 25 questions? Is there a particular title for that on your website?
It's on the bottom of the home page. It says download 25 tips for making and keeping more money.
Okay. Great. Thank you, Maddie.
You're welcome. Is there anything else? Well, that covers everything that I had hoped to have covered. If you have questions, Becca put the 25 tips in the chat. So if you want to download from there, that will give you what you need to do. Okay, we are good to go. I hope this has been helpful. And if you have any questions, don't hesitate to reach out. Thank you.